You know that classic Warren Buffett saying, when the tides go out, you see who's swimming naked, meaning it's hard to tell who's a good investor while markets are going up and everyone's making money, but when the market collapses, you see which people actually know what they're doing. Well, in that analogy, in 2022, the tides went out and I was appropriately dressed for the beach, I guess. Sorry to disappoint some people clicking on this video hoping I'd be in tears or on my knees or something, but in 2022, despite the volatility in the markets, and actually despite some significant mistakes I made in the portfolio, I have continued to outperform the market, not just in 2022, but now over a 5-year compounded period. So today, I'm going to be talking about the performance of my portfolio, as well as 2 distinct mistakes that I made over the past 12 months that caused a lot of pain in the portfolio and what lessons you can draw from them. A quick reminder before we start, the purpose of this video, as is the case with all the videos on my channel, is to help you understand key investing principles. And even though I use modern examples sometimes to teach those principles, I'm never recommending or advising you in regards to those specific examples that I talk about. The first thing we can notice when taking a look at my portfolio is that it is extremely concentrated. In fact, I only have 5 significant investments in the portfolio and then a couple of smaller ones that make up smaller positions. And this level of concentration is by design. The reason why it's like this is because it takes an extreme amount of research over a long period of time to understand and learn enough about a business and its competitive environment to be confident in making an individual investment. And if you don't put in the hours of research, you are going to make mistakes. And I know this because I've done that before a few times. One good example is back all the way in 2018. I invested for the first time into Thor Industries, and I made a significant error because of my lack of understanding in the business in regards to where their current profitability was and what it was likely to do over the next few years. And in hindsight, it was really a simple error that I wouldn't have made if I had just read more annual reports going back further to understand more of a long-term history of the business and the cyclicality of the RV industry. Since then, I now do far more research on companies, including reading every single publicly available annual report, which is something that I did for Thor Industries immediately after making that mistake. So what has this got to do with a concentrated portfolio? Well, if you are in fact keeping up to date with a few companies and spending tens of hours researching each of them, it's actually not possible to have 20 or 30 stocks in your portfolio. If you have 30 stocks in your portfolio, there's no way you've spent tens of hours looking at each of them. It's just not possible. For me personally, I've found that I would be happy with a portfolio concentrated between 5 and 10 businesses, but getting 8, 9, 10 businesses in the portfolio, that's a lot of research you're doing keeping up with all of those companies. Where I am right now, which I believe I have 5 in the portfolio, it's very concentrated. It's a good level, and I think I can keep on top of the companies in it. And my concentrated portfolio really hasn't changed all that much. Certainly the businesses in it have not really changed at all. Some of them have gone up in percentage and down based on whether I've added to them or how they've performed in the last couple of years. But really, it hasn't changed all that much. I won't be talking about every position in my portfolio in this video. I'm just going to pick out a couple of key examples where I think there's some investing lessons that I can draw on. The third largest piece of the pie is my index fund investments. And this index fund portion has been a feature of my portfolio since day one. The percentage has varied over time, but in the last few years, it's stayed between 10 and 15%. I spoke a little bit about index funds in my previous video where I was talking about how I regularly contribute to it from my income in a kind of a dollar cost average schedule so that I'm not swayed by the market. And really the purpose of this is to have kind of this solid foundation in the event that my individual picks don't work out as I expect. The second largest piece of the pie is my cash accounts. Currently, I have about 26% of my portfolio in cash, and that is noticeably down from the almost 50% at the start of the year. And that decline is actually almost entirely due to one investment, which I will talk about in a little bit, and it's of course the largest piece on the pie. But first of all, how do I think about cash in my portfolio? Am I keeping a set percentage? Am I waiting for the market to bottom or something so that I can put that into the market? How am I thinking about cash? Well, the right way to think about cash, especially from a value investor perspective, is you want to be 100% invested. You would love to have enough investment opportunities to put all of your cash to work, have all of your cash compounding at 10, 15, or even more percent per year. So I want to be 100% invested. What prevents me from doing so is simply the investment opportunities available to me. I am constantly researching new companies, revisiting old companies I've analyzed, and looking for gems in the stock market where I can find essentially an amazing company going through some kind of short-term headwinds, short-term problem, or short-term mistake or error that they've made that they need to fix, that temporarily suppresses the stock price, and I'm looking for those opportunities to invest into great companies at cheap prices. I am never timing the market. I think this is something that is hard for some people to understand, the difference between having cash because you can't find opportunities versus having cash because you're trying to speculate on when the market will go up again. But those two things are distinctly different. One is holding back on investing based on an calculation of the cash flows that businesses can produce, and the other one is just gambling on when you think stocks will go up. I buy businesses all the time because they're cheap relative to future cash flows, and they continue to go down. I'm not trying to predict that that stock has finished falling. I'm just waiting for it to fall to a point where it's cheap enough where the investment makes sense over the long term, over 10 plus years. And this year, I got the opportunity to invest significantly into one very good investment. And that now makes up my largest position in the portfolio, which is Netflix, currently representing 26% of my portfolio. And pretty much perfectly, you can see that I was able to put about half of my cash position that I had at the start of the year to work in Netflix. So ideally, over the next 6 or 12 months, I'll be able to find 1 or 2 more great investment opportunities, and I can invest the remaining 25% of cash. I started talking about Netflix on the channel as early as I believe in February, and that's because I did dip my toes in and make a minor investment during that time. However, I actually only significantly invested into Netflix after it fell significantly in April. And that's really important to understand, because even though the stock is down 65% from its peak, I'm actually up on my Netflix investment, and I'm up by a lot on it. Netflix, in my view, is a really interesting business that's facing clearly some short-term headwinds. It's also facing a lot of negative press, which I have my opinions about, but I probably won't have time to talk about in this video. And then most interestingly, it's a stock that is hated by both growth investors and value investors at the same time, and that is really rare. Growth investors hate it because it's no longer the 30+% per year growth darling that it's been for so many years, and there's been a temporary blip, and as is the case with most growth businesses, when there's a little bit of a blip in subscriber growth or revenue growth, the stock gets absolutely destroyed, and those investors look to speculate on some other kind of short-term investment. But it's also hated by value investors at the moment, because to a lot of value investors, they think it's kind of a cash burn pit where they're just burning money on content, and it's a business that's going to continue to do that and never become profitable after content spend. And while those factors have certainly hurt Netflix's stock in 2022, none of them really have any impact on the long-term story for Netflix. And that includes their strong and growing share of TV engagement, their investment in localized foreign content, and most importantly, their gigantic scale advantage in an industry where there's really only going to be 2 or 3 or maybe 4, if that, profitable companies at the end. All right, so let's talk about the performance of my portfolio in 2022 and compare it to the S&P 500 index. For most of 2022, my portfolio pretty much tracks alongside the S&P 500, and you can see there's a slight divergence only really occurring in the last 2 to 3 months. I'm not really celebrating the difference between my performance and the S&P 500 for a couple of reasons. One is it's very, very short term. 2, it's mostly driven by short-term performance of Netflix stock, which Netflix is extremely volatile. So by the time you're seeing this, it could be up or down 20%, especially because earnings come out tomorrow for Netflix. So I'm not really concerned about short-term performance there. But broken down into capital gains, dividends, and currency, my performance this year has been negative 13% in capital gains, plus 1% in dividends, and plus 8% in currency exchange, for a total of negative 4% for the year. And that compares to the S&P 500 index, which is negative 26%, plus 1% for dividends, and plus 15% for currency exchange, for negative 10% overall. So I'm doing marginally better than the S&P 500 over the past 10 or so months, but I'm much more interested, of course, in long-term performance, and that's what we'll look at the end of this video, where we'll see my 5-year compounded return in my portfolio. But before we do that, I want to talk about 2 mistakes that have happened this year that have caused some negativity in the portfolio. The first is Meta Platforms. It's actually one of 2 stocks that I sold in the last 12 months, and since I sold it, the stocks continued to fall quite considerably. So my mistake wasn't that I sold Meta, it was really that I took so long to get rid of it in my portfolio. In a video from March 2022, I discussed my reasons for selling, which included the threats to their core advertising business, as well as their shift in focus to the metaverse, which is really a complete unknown, speculative business. And what I really should have done in hindsight is dug deep on the app tracking stuff as soon as I started to hear about it, rather than kind of stick my head in the sand. And ultimately, I didn't really learn a lot about it until the beginning of this year, the end of last year, and then ultimately I sold the stock in March of this year, which I don't really have a rational explanation why I waited so long. As I said, I should have learnt more about the issues at the time so that I could have made a rational decision immediately, rather than just holding onto a stock which at the time, at the beginning of 2021, was doing extremely well and probably drove me to want to emotionally hold on to the stock. So that was clearly a mistake. During the same time period, I made a similar mistake with ASOS. I first invested into ASOS in late 2021. I just dipped my toes in. It was only a couple of percent of the portfolio. But what happened immediately after that was the CEO stepped down, and the CEO was a big part of my investment thesis. But again, instead of just selling the stock immediately, which I definitely should have, I wanted to wait to see what the new CEO and the new management team would look like. In the end, I actually lost 80% on ASOS. Fortunately, as I said, it was only a couple of percentage points in my portfolio, so the overall impact was pretty small, but that was certainly a powerful lesson in, and on top of the meta investment, in trying, whenever I hear some uncertain news around the company, I should go deep on it immediately and make a quick decision. But with that said, let's take a look at the performance of the portfolio over 5 years compounded. So these are compounded returns, and this also includes the cost of trading, which I don't really trade that much, really at all, but it does include that in these returns. So again, in terms of capital gains, dividends, and currency, 9.1% per year compounded return in capital gains, 2% per year in dividends, and 3.5% from currency, for a per year compounded return of 14.45% over almost 5 years. And if we compare that to VTS, which is an Australian listed US stock market index, they had 11.2% capital gains, 2.1% in dividends, for a total of 12.7% per year. And since the index is listed on the ASX, the currency is actually included in the capital gains figure. That's why it says 0 for currency, but the capital gains would include both capital gains and the currency impact. So overall, despite some mistakes, over the long term, I'm still doing pretty well. I'm still beating the market by about 2% per year, and that might not sound like a lot, but 2% per year over 40 years, for example, is the difference of a doubling in the portfolio. So for example, if you earned a 10% return and over 40 years and your portfolio ended at $1 million, if you had earned 12%, just 2% more per year, you would have had 2 million. Actually, you would have had 2.2 million. So I'm still very, very happy with beating the market by 2%. If you enjoyed this video and you want to see more, make sure you hit that subscribe button. We're getting really close to 100,000 subscribers. So if you want to be a part of our team in the first 100,000 subscribers, then make sure you hit that button. But with that said, I'll see you guys in the next video. See you later, guys.